We will now look at the provisions for set off and carry forward of loss. Three steps are basically involved. The first is inter-source adjustment, under which we set off loss from a source against income from another source but under the same head. This is section 70. Second is inter-head adjustment, under which if the loss cannot be set off in step 1, it is set off against income under another head but for the same assessment year, and this is section 71. Third is carry forward and set off. If the loss still cannot be set off, that means even after inter-source and inter-head adjustment, then it is carried forward to the following assessment year for being set off against income of that assessment year. So these are the three steps involved in the process. Now first we look at step 1, which is inter-source adjustment under section 70. We set off loss from a source against income from another source but under the same head. Okay. As you can see on your screen, this is the table depicting the rules in this regard. These are the heads of income, income from house property, PGBP, capital gains and IFOS, and these are the various categories of losses. Now, as far as income from house property is concerned, loss from a house property can be set off against income from another house property and there is no restriction. As far as the PGBP head is concerned, it depends on the category of business. Loss from a speculation business. Loss from a speculation business can be set off only against income from another speculation business. Okay? Not from the other categories of business. What about section 35AD? Loss from a specified business referred under section 35AD can be set off only against income from another specified business, not against other categories of income. Loss from any other business can be set off against income from another business and there is no restriction in this regard. Coming to the head capital gain, long-term capital loss can be set off only against long-term capital gain. But short-term capital loss can be set off against any capital gain, whether long-term or short-term. As far as income under the head IFOS is concerned, loss from the activity of owning and maintaining race horses, OMRH. Activity of owning and maintaining race horses. So loss from this activity can be set off only against income from such activity. As far as winnings is concerned, that means winnings from lottery, crossword puzzles, horse races, games, etc. No loss can be set off against such winnings. No loss can be set off against such winnings. And the loss in respect of such activities in the nature of winnings also cannot be set off. So winnings are basically completely ring-fenced. Loss from any other source under this head can be set off against income from another source, but except from winnings. We also need to keep in mind that this activity of owning and maintaining race horses is different from winnings from horse races. Winnings from horse races is covered under winning, and OMRH is what? It is basically the activity of owning and maintaining race horses. Now, if the source of income is exempt, say for example under section 10, then loss from that source of income cannot be set off against income from a source which is taxable, right? So if an income is exempt, it is not taxable. Similarly, the loss from that source of income which is exempt, it also cannot be set off against income from a taxable source. We will now look at step 2, inter-head adjustment under section 71. If the loss cannot be set off in step 1, that is inter-source adjustment, then it can be set off against income under another head but for the same assessment year. So this is the income and this is the loss under various heads, right? And now as far as loss under the head income from house property is concerned, it can be set off against income under any other head, but up to a limit of rupees 2 lakh. If the loss exceeds rupees 2 lakh, it cannot be set off under interhead adjustment. As far as loss under the head PGBP is concerned, it can be set off against income under any other head except salaries. So it cannot be set off against salary income. As far as capital gains is concerned, loss under the head capital gains cannot be set off against income under any other head. It cannot be set off. Interhead adjustment is not possible for capital gains loss. And as far as loss under the head IFOS is concerned, it can be set off against income under any other head. Now what we need to note is that there are certain losses and incomes that are ring fenced. So the losses that are ring fenced are the losses which cannot be set off against any other income, both intersource as well as interhead. These losses cannot be set off against any other income but only against that income. So long-term capital loss can only be set off against long-term capital gain. Loss from speculation business can be set off only against income from such business. Loss from specified business referred under section 35AD can only be set off against such business under 35AD. Loss from activity of owning and maintaining racehorses can only be set off against income from such activity. Similarly, there are certain incomes that are ring fenced. That means no loss can be set off against these incomes. And this is both intersource or interhead. So no loss can be set off against winnings and no loss can be set off against undisclosed income. So if there is winnings and undisclosed incomes, the whole of that amount will be taxable and it cannot be reduced on account of set off. Interhead adjustment under section 71 can be done at what stage? Only after making intersource adjustment under section 70 that we discussed previously. Now this limit of rupees 2 lakh for set off of loss under the head income from house property, it is only relevant as far as interhead adjustment is concerned. It is not applicable for intersource adjustment of loss within the head income from house property. We looked earlier that there is no restriction in that regard. We should note that there is no particular order of set off which is specified under section 71, right? So a loss is supposed to be set off against the incomes and there are incomes under multiple heads. So the question will be how to set off, where to set off first and where to set off next. So the idea should be to minimize the total income and therefore the tax liability. So we should first attempt to set off the losses which cannot be carried forward because otherwise they will lapse. Where there is a loss which can be set off against, say, multiple categories of incomes which are taxable at different rates. In such case, it will be better to first set off such loss against the income taxable at a higher rate and then against income taxable at a lower rate. Now we have looked above that speculation business is relevant in the context of set off because the loss from a speculation business can be set off only against income from such business. So the loss from a speculation business is ring fenced. So the question is, what is a speculation business? So speculation business results from speculative transactions which are carried on by an SSE which are of such a nature as to constitute a business. That is what we call speculation business. So the question is, what is the meaning of speculative transaction? It means a transaction in which a contract for purchase or sale of any commodity, this includes stocks and shares as well, is periodically or ultimately settled otherwise than by the actual delivery or transfer of the commodity or scrip. So the contract is settled, but there is no actual delivery or transfer of the commodity or scrips, right? For example, day trading in shares. So without the actual transfer or delivery of shares, the contract are settled and therefore they are categorized as speculative transactions. But there are 5 categories of transactions which are not deemed to be speculative transactions, even if the contract is settled otherwise than by actual delivery or transfer. One is a hedging contract entered into by a manufacturer or merchant to guard against loss through future price fluctuations. Hedging contract entered by a dealer or investor in stocks and shares to guard against loss through price fluctuations. Forward contract entered by a member of forward market or a stock exchange to guard against loss. Trading in derivatives and securities carried out in a recognized stock exchange. And trading in commodity derivatives carried out in a recognized stock exchange, which is chargeable to commodities transaction tax. But the condition of CTT is not applicable to trading in agricultural commodity derivatives. So these are 5 transactions which are not deemed to be speculative transactions in this respect. We now look at step 3, which is carry forward and set off. If the loss cannot still be set off under steps 1 and 2, that is inter-source and inter-head adjustment, then we need to carry it forward to the following assessment year and set off against income of that year. So now we look at what are the relevant sections as far as carry forward and set off is concerned. What is the loss that can be carried forward? What is the income against which brought forward loss can be set off? And what is the time limit for carried forward, if any? Is return of loss to be filed in time? Is that a requirement? And should original business continue? Is that a requirement? So there is a requirement as far as filing of return of loss in time. So this is provided by section 80. Certain losses, not all the losses, certain losses which are specified cannot be carried forward unless they are determined in pursuance of a return of loss which should be filed in accordance with section 139(3) and within the time allowed under section 139(1). So there are certain losses for which a return of loss should be filed as per section 139(3), and this return of loss should be filed within the time allowed, which is under section 139(1), which is for furnishing of return of income, which is either 31st of July, 31st of October or 30th of November. And this is provided under section 80. If this is not complied with, then such loss cannot be carried forward to the following assessment year. So what is disallowed under section 80 is the carry forward of loss of the assessment year in which it was first computed, right? So consequently, inter-source adjustment of loss is not affected, that is not barred. So even if return of loss is not filed in time, inter-source adjustment of loss under section 70 is possible within that year. Similarly, inter-head adjustment of loss under section 71 is also not affected. That can also be freely done even if section 80 is not complied with. Similarly, loss of an earlier assessment year is also not affected. Such loss of the earlier assessment year can be brought forward to the current year and it can be set off in the current year. Even if there is default under section 80 in the current year, it doesn't matter. So the loss of an earlier year can be brought forward and it can be set off, and if it still remains unabsorbed, then it can be carried forward to the subsequent year. So what is impacted by section 80 is the carry forward of loss of the current assessment year. So what is the effect? The effect is that only the unabsorbed loss of the current assessment year lapses. If section 80 is not complied with, that means if the return of loss is not filed under section 139(3) within the time allowed under section 139(1). We will now look at various provisions for carry forward and set off of loss. Section 71B deals with loss under the head income from house property, which can be carried forward, and the brought forward loss can be set off against income from house property. The time limit for carry forward is 8 years, so it can be carried forward till a period of 8 years. And there is no requirement in this respect that the return of loss be filed in time. Section 73 deals with loss from a speculation business. It can be carried forward and set off against income from any speculation business. Not against income from any other business, but against income from any speculation business. There is a reduced time limit for carry forward, which is 4 years only. And the condition of filing return of loss in time applies. It is not required that the original business continue. And what is this? It is not necessary that the business in which the loss was incurred should also be carried on in the year of set-off. So it is not necessary that the speculation business in which such loss was incurred should also be carried on in the year of set-off. The assessee may be carrying on some other speculation business in the year of set-off. Successor cannot carry forward and set off the loss of predecessor. The condition is that if there is a succession in business and if there is a loss of the predecessor, then the successor cannot carry forward and set off such loss. But there is an exception. The exception is in the case of inheritance. In the case of inheritance, even the successor can carry forward and set off the loss of the predecessor, but not in any other case. Section 73A deals with loss from a specified business referred under section 35AD. This loss can be carried forward and set off against income from any specified business. But what we need to note is the loss can be set off against income from any specified business which is referred under section 35AD, whether or not it is eligible for deduction under section 35AD, because there is a list of specified businesses, but there are certain further conditions to be satisfied so that 35AD deduction can be claimed. Both are different aspects from a loss point of view. So the loss from 35AD business can be carried forward and set off against income from any specified business which is referred under section 35AD, even if that specified business is not otherwise eligible for deduction under section 35AD. That doesn't matter. Now, the benefit is that there is no time limit for carry forward. It can be carried forward indefinitely till it is fully absorbed. The condition of return of loss to be filed in time applies. Original business need not continue in the year of set-off, and successor cannot carry forward and set off loss of predecessor. What about loss from any other business? It is covered under section 72. That means loss which is not from a 35AD specified business or speculation business. So the general business loss can be carried forward and it can be set off against income from any business or profession, whether it be a normal business or profession or a 35AD business or a speculation business. The time limit to carry forward is 8 years. Return of loss needs to be filed in time. Original business need not continue in the year of set-off, and successor cannot carry forward and set off loss of predecessor. What about unabsorbed depreciation? This is covered by section 32(2). Now, unabsorbed depreciation can be carried forward and it can be set off against any income, but except under the head salaries, right? Why? Because unabsorbed depreciation becomes part of the current year's depreciation under section 32(2). Hence, it can be set off against any income except under the head salaries. It can be set off even if the business to which it relates does not exist in the year of set off. And the benefit is that there is no time limit to carry forward. Return of loss to be filed in time, that condition is not applicable. Now, there could be a situation where in the year of set off, we have current year's depreciation, the unabsorbed depreciation, as well as brought forward business loss. So the question would be, what should be the order of set off? What is it that we should set off first and then next? So the order of set off is this. First, we need to adjust or deduct or set off the current year's depreciation. Second, brought forward business loss, and lastly, unabsorbed depreciation. Coming to loss under the head capital gain. This is section 74. As far as short-term capital loss is concerned, it can be carried forward and set off against any capital gain, whether short-term or long-term. The period is 8 years and the return of loss needs to be filed in time. But as far as long-term capital loss is concerned, it can be carried forward and set off only against long-term capital gain, not against short-term capital gain. And the time period remains for carry forward at 8 years and return of loss condition applies. Finally, under the head IFOS, only one loss can be carried forward to be set off, that is under section 74A, and that is loss from the activity of owning and maintaining race horses. It can be carried forward and set off only against income from such activity. There is a reduced time limit of carry forward of 4 assessment years. The return of loss condition applies. And in this particular case, it is required that the activity in which the loss was incurred should be carried on in the year of set off as well. Successor cannot carry forward and set off the loss of predecessor. Now, certain points that we need to keep in mind. As far as brought forward loss is concerned, it can be set off only against income under that head, which we have noted in the table above. Inter-head adjustment is not possible. For example, loss from house property can be carried forward and set off against income from house property, not against income from any other head. What about rupees 2 lakh limit of set off of loss from house property under any other head that we noted as far as inter-head adjustment is concerned? That limit is not applicable in respect of carry forward and set off of such loss under section 71B from income from house property. That limit is only in respect of inter-head adjustment. Loss which is not specified above in the table cannot be carried forward, and therefore it simply lapses if it is unabsorbed for that assessment year. So for example, loss under the head income from other sources, right? It cannot be carried forward and therefore it lapses, but there is only one loss which is from activity of owning and maintaining race horses that is only allowed to be carried forward. If there is any other loss under this head IFOS, there is no provision to carry forward such loss.